All right, it's 5:30. Let's get started. I was using the class. They got a couple right. So yeah, actually using 2 by 5 today. All paid. And by showing up tonight, you have distinguished yourself. I call this the garbage lecture. No, I'm open to us the first exam on Business Course's website. So this is the class where I lecture over material that's not on the first exam. So you're polluting your brains by even being here tonight with information that won't be tested for another 4 weeks. So impressive. Just like showing up here to the garbage lecture. I have categorized all of you as a unique group. With that said, I want to toggle over here to our My Business Courses website. So when you come out here, you'll click on the left-hand bar, you'll click Module 4, and the exam is right here. Just out of curiosity, is anybody taking it already? Okay, 1. All right, you're in a group all by yourself. Well done. And what do you think? Okay, wasn't bad. And the first exam's not. Most of modules 1, 2, 3, and 4 have been covered somewhere in your pre-reps. So hopefully it was all review. We're gonna very quickly pivot into some technical accounting starting tonight and moving throughout the semester. So it gets harder from here. Exam 2 is pretty tough. You click on that exam and you get a format of 40 multiple choice questions. You have 2 hours to take the exam. You'll recall I advised everybody in class that you need to come prepared to not to have to rely on your open note format to look all those up for your employee, or you will run out of time. Was that your experience? Okay, give or take. So heads up there. Any questions on the exam or homework or scheduling or just anything? Okay. Tonight I plan on lecturing over Module 5. Module 5 is going to take us up into a concept called revenue recognition. GAAP accounting is full of rules, and one of the, I guess you won't be surprised in the slightest to find out that there's a whole bunch of rules that govern how revenue shows up on the income statement. It's the simplest of the financial statements, or at least it would seem that way. But even the number at the top of the page is not as simple as you would think. Revenue, how much money did you make? If you're working for a retail, if you're working for a Gap, every time you sell a pair of jeans, that shows up as revenue. Or my daughter just got a job working for Bahama Bucks. Did I tell you that? Bahama Bucks is I call it snow cones. They just call it snow. They rebranded snow cones. And it amazes me. I don't understand something about the world. I don't understand a lot about the world, but I really don't understand snow cones. Because this franchise, it must be successful because they're all over the place. But Kansas City got there first, and they built a standalone building with a drive-through. They didn't just rent out some shop in a strip mall. They built a standalone building with a drive-through to sell snow. So my daughter's 15. I've been out there to get my first snow cone and any flavor you can possibly imagine. And I did a coconut snow with Oreo toppings, $8. And I thought, how does this business function selling $8 snow cones? But it works. So it doesn't appeal to an old man like me, but it absolutely appeals to her generation. And they're off to a strong start selling $8 snow cones. And I just thought back to when I was at the swimming pool growing up, a snow cone was 50 cents. And that was a real decision I had to make because with my 50 cents, I could buy a snow cone or I could buy 10 Latin Cats. I was always into it for the joke. Like the jokes on the Latin Cat, that's where my 50 cents went. So I don't understand $8 snow cones, but they sell $8 snow cones, and when they sell them, they book revenues. That's the top of Bahama Bucks income statement. It says revenues. Those revenues come from snow. Then
if you're curious, our franchising page says that the average Bahama Bucks has a 21% average net profit.
21%, well, and then what's their raw materials cost? Almost nothing,
Right.
and it's just syrup, sugary syrup, 21% margins on. Go check it out, it's, I wish them luck, but probably not on the top of the businesses I would have invested in personally. So, Bahama Bucks doesn't have this issue, but most of the companies that you're looking at, tonight we're gonna be looking at Pfizer. When Pfizer sells drugs into the marketplace, whether they're selling to doctors or hospitals or a pharmaceutical manufacturer, a lot of those sales are done on credit, so you don't get the cash. And when there's not cash that changes hands in exchange for goods or services, there's rules that govern how you record those revenues. Are those real revenues when you don't get cash? Just conceptually, if you own the business and you don't get the cash, you just get a promise of cash in the future. Does that count as a sale? Does that count as revenue? GAAP tells us it counts, but we gotta make some adjustments. GAAP tells us it counts, so we have to go to accounts receivable. So anybody that's looking at the balance sheet or our financials as a whole can tell, well, that accounts receivable number represents sales that were made that have not yet been collected. And maybe for a company like Pfizer, that's a pretty easy thing to forecast because those accounts receivable sales, they come in month after month after month after month, and their customers are usually pretty good at paying about it. Okay, what if we're, that's called accounting for bad debts and accounts receivable. What if we're the Gap and we sell a pair of jeans and somebody returns it the next day? Not a sale, do they get to report that as revenues? No, we don't get to report that as revenues. We would book a sale today and tomorrow we would just reverse it, we take it off the books. Well, Gap has and Financial Accounting Standards Board, they say, if you're in an industry and you know that a certain percentage of your goods are gonna come back, you need to book that in advance. You need to book a sales return and allowance account. And I'm sure you've all had this in your accounting pre-req. We're gonna look at the rules associated with that tonight. And as always, we're gonna play a little game of Follow the Penny. And I'm gonna ask you, which accounting policy would you implement if you were trying to boost your earnings per share by a penny this quarter? Or if you were trying to exercise those stock options? So that's all module 5, and then our authors, they throw a whole bunch of stuff in the junk drawer at the end of the module that I may or may not have time to review tonight, like research and development and other items that are on the income statement that I'm sure you all can take in stride on your own, but maybe we'll get there. Okay, let me toggle over here and we'll talk a little bit about revenue recognition. Okay. And yes, we have Pfizer's income statement here. We start with revenues of this is Pfizer, so those are millions. So that's $100 billion in 2022, $80 billion in 2021, and $40 billion in 2020. So there's COVID for you. I mentioned I thought it was very interesting that we got to look at Pfizer during such a seminal period of time for them. They more than doubled their revenues from 2020 to 2022. And we're going to look at some of the policies that allowed them to book those tonight. Part of your homework for your research project, I try to chunk this out week by week and give you some advice on what you should be looking at. By now, you should have found your 10K, found your annual report, understand what's on the investor relations website. You should get to familiarize yourself with the accounting practices of your company week by week as we go. I want you to find out what your company is using as a revenue recognition policy. And the more complicated the business, the more complicated that policy is going to be. We're going to look at several tonight, but by no means are we going to cover every possible policy. I remember early in my career as an analyst, I was doing some work on Boeing, so a very large manufacturer of aircraft. And they had one of the most complicated revenue recognition policies I've ever seen. They called it procurement account. So Boeing, they would go out and sell planes at the time they were building it was the new 787, and the 787 was the first airplane in the world that was built with a 100% carbon fiber fuselage. And the strength to weight ratio of that carbon fiber fuselage was supposed to save 30% on the gas that any airline company that would buy them. And they sold them before they ever made them. 5 to 8, but maybe even 10 years in advance, they would make sales. And companies would have to pay Boeing money just to reserve their plane to be delivered in 10 years. And there's some very complicated accounting around when those cash flows that came in 8 to 10 years in advance, Boeing would have the cash, but they couldn't book it as revenue just yet because they hadn't done it. Well, as they designed and built the plane, they would recognize those revenues over time, along with milestone payments that would typically accompany the orders of those planes. So these policies can get very, very complicated. We're going to start simple, look at 1 or 2 more complicated policies, but then we won't go real deep into that for our testable material. You may have to dig deeper for the companies that you're working on. When you find that revenue recognition policy in the notes of your 10K, it's going to look something like this. For Pfizer's revenue recognition, they acknowledge that they have a variety of deductions from revenue. From their top line revenue, they have to adjust for chargebacks, rebates, sales allowances, and sales return. After they deduct for all of those chargebacks, rebates, sales allowances, and sales returns, they get net revenue. So they start with gross revenue. Every sale that they make goes into gross revenue. And then they say, well, wait a minute. Some of these are going to come back. Some of these have discounts associated with them. Some of these have other allowances that we need to make. So we have 1, 2, 3, 4, 5 entries or so that are going to adjust the gross sales number. And after we made those adjustments, we have something that's more quote unquote real. So we're going to talk about revenue recognition timing, sales returns and allowances. This third bullet point, maybe I can say to you all some brief. Deferred revenue. That's that revenue I was talking about with Boeing. People would pay them to reserve their planes in advance. That's deferred revenue. It also goes by another term, unearned revenue. I went an embarrassing long period of time in my career before I figured out that deferred revenue and unearned revenue are the same thing. That's always the same thing. There's no nuance to it. Sometimes our authors use the term deferred revenue. Sometimes they use the term unearned revenue. And that pissed me off for a long time because I thought, well, they're different terms. They must mean different things. Why are we using them in different places? It's the same thing. Deferred revenue equals unearned revenue. And then we'll talk about foreign currency exchange rates if we have time tonight. Okay, let's move into sales on credit and talk a little bit about accounts receivable. When you get to talking about the revenue recognition, there are several components that you need to keep in mind. The first is we have to be able to identify the contract. And the contract is going to state several things. The timing, the price, the delivery, when the goods change hands. All of this is relevant for booking revenue. So the contract will have terms like number 2 and number 3, the performance obligation, explicitly what is it that we have to do before that contract is satisfied. And once that contract is quote unquote satisfied, we can book that revenue. Performance obligations, transaction price. Step number 4, how we allocate the transaction price. There are several different ways to do that in a simple goods or services transaction. It's not relevant, but if you're talking about purchasing an airplane, like from Boeing, then how we allocate the transaction price is very relevant. If you're talking about a long live construction project. Allocating the transaction, that's gonna be very, very relevant. They were, some of the longest I've ever seen would be like building a nuclear power. You set out to build a nuclear power plant today, you'd be lucky to get it done in the next decade. So how do you allocate the transaction price for a several $billion nuclear power plant that probably requires the buyer to pay in installments over the period of the time that the plant is actually built? So we're gonna look at a percentage of cost method that we might use when we're allocating that price over time. And then lastly, we'll recognize revenue. Typically, this is just a general rule, general guideline. We'll recognize revenue typically when the performance obligation is satisfied. Complications. These are things that we have to work around. When we look at Pfizer's revenue recognition policy just a moment ago, they adjusted for things like the chargeback, sales returns and allowances, so on and so forth. These are the common ones right here: rights of returns, gift cards, non-refundable upfront deals, bill and hold arrangements. Look for these in the notes of your 10K file. If there's anything significant, anything material, it'll be disclosed, and the accounting and its policies will also be disclosed. But then it's your job to say, okay, is this accounting policy material? And you need to do the analysis on it. We're going to look at some of the ratios that you might look at to decide if any analysis needs to be done. Franchises have their own deferred revenue issues, variable consideration, so that's recognized when the expected amount to be received when goods or services are provided. So that sometimes that can vary, like with a in construction, variable consideration might be a cost plus contract, if we're familiar with cost plus contracts. So these some people were preferred to that in construction. So bring them back. Very common for them to use a cost plus contract. So they'll bid on a job, say they're building a gas turbine of some kind. And their price will be, well, we're gonna charge you 30% margin on top of what it costs us. And then all the costs are just passed through and they mark it up. Material, labor, everything that goes into that project, and then they just mark it up. That's one of the ways that a construction company can protect their business when they don't know what their input costs are going to be over a 3, 4, 5-year term. Case in point, earlier this year, President Trump implements tariffs on almost all imported goods and services. Liberation Day, 20% tariffs. So it's been dialed back significantly. But in an environment like that, you can add significant costs to your inputs for, well, all goods and services really, but especially construction. That's when a cost plus contract really comes into play. Let's look at a cost to cost method for recognizing revenue. This is Raytheon. Raytheon's disclosure tells us that for performance obligations satisfied over time, revenue is recognized on a percentage of completion basis. So if they're 10% done, and they know that because they've spent 10% of the costs that they expected to spend or what they budgeted for, then they're going to book 10% of the revenue. Anybody see any way that you might introduce some shenanigans of that little proposition? It's Raytheon that gets to say, yes, we've spent 10% of the costs. Or yes, we've spent 15% of the cost or 20% of the cost. They make the budget. So they're the ones that decide what percentage of completion the project is. And if they decide, then they're basically deciding their revenues. So if you got a project that's going to be completed over 4 years, okay. Well, if it's pro rata, then you go 25% of the revenues every year. Then maybe it's supposed to be that way. But if the CEO is retiring next year and they want to add their bonus this year, well, maybe they say, well, we actually spent 30 or 35% of the total expected budget this year. So we're going to book 30 or 35% of the total revenues this year. What happens when you book 30 to 35% of the revenues this year? That number just cascades down from the income statement and ends up in net earnings, which ends up in earnings per share, which ends up in your CEO's bonus. That's a nice little parting gift for them that would be very easy to manipulate based on percentage of completion accounting. Now, the auditor is going to come in here and look at this, so you have to have some justification. It's not as easy as I make it sound. You got to tell a good story to go with it. But I think you'll find that once you're in that CEO role, you've become pretty good at storytelling, and you'll come up with something. I have been all. I'm just introducing you to how you need to think through it. Here's the account. It's all in the test, but there's some proof of it. Raytheon signs a $10 million contract. Construction will take place for 2 years and cost $7.5 million the first year. And the cost incurred at year one was $4.5 million. Year two was $3 million. So in year one, they've incurred 60% of the cost. 60% of $10 million is $6 million in revenue recognized. That leaves $4 million of revenue to be recognized in the second year. And that's an oversimplified example, but I think you get it. Percentage of cost method or percentage of completion method is pretty easy to follow. Questions? Do I need to go deeper on that one? Okay. So, cost to cost method. Okay. Note that the cash collected from the customer may or may not coincide with the revenue reckoned. Star that, highlight that, come back to it. This is, when we just talked about that, that's sales on credit. The cash and the revenue recognized, they don't always match. Come back to that, because it trips up students all the time. Okay, here's another thing I wanted to point out in Raytheon's fine print. When you read Raytheon's fine print, you're going to notice it's right here in the middle. Okay, contract assets. Okay, so because the customer retains a portion of the contract price until completion of the contract, our U.S. government fixed price contracts generally result in revenue recognized in excess of billings, which we present as contract assets on the balance sheet. Okay, what's that mean? That means if you're doing a report on Raytheon and you're looking at their balance sheet, you're gonna see assets, accounts receivable, a whole bunch of other stuff that's pretty typical when you're looking at a balance sheet. But one of those line items is going to be labeled contract assets, and you're going to be scratching your head thinking to yourself, I don't remember Vern talking about contract assets. I don't remember covering contract assets when in my prereq. What the heck are contract assets? This is a very common response. Everybody in this room is going to have this question. Maybe it pertains to contract assets. Maybe it pertains to something else on the balance sheet. Maybe it pertains to something else on the income statement. My point is, you're going to go have to do some digging in the notes to understand what the heck is it. Because the nomenclature that companies use to describe their accounts doesn't have to be the same company to company. So you got to look it up. You got to do some digging. You got to do some work. Okay, what are contract assets? Oh, okay. Well, contract assets happen when Raytheon recognizes revenue in excess of billings. So if they haven't billed for it, they obviously haven't collected the cash. So this is another term for accounts receivable. It showed up as revenues, but they don't have the cash for it yet. So now it sits on their book like an asset, which is cash to be collected in the future. So we can have that as an asset thing. But unless you go read the fine print, you have no idea what that is. Now that you've read the fine print, you can say, okay, for all intents and purposes, as I approach this class, I'm going to treat that just like accounts receivable, because it is, only we owe it to the government. Okay, let's move into how we account for sales allowance, sales returns and allowances. When something goes bad, when we sell something to. All right, when was the last time you took something back to the store?
The Amazon or?
Sure, that counts. What do you
Last
get?
week.
Last week, okay, what was it?
There's some pins.
Okay, some pens. Got some pens, didn't work out, didn't like them, wrong color, whatever. Wrong size, I don't want this stuff anymore. Amazon had already booked that. Kate, right?
Yeah.
Okay, Amazon had already booked that as a sale. That was revenue for Amazon, but we're gonna send them back. Okay, so now Amazon's gotta reverse that transaction, right? Yeah, FASB says we have to anticipate that to some extent in advance. That's what we're talking about here with sales returns and allowances, and they include rights of return, sales discounts, retailer promotions, so on and so forth. And there's several different ways that we can take account of this. But before I just give you the answer or tell you the answer, if you own the business, if you're Amazon or you're Walmart or you're some retail store, how would you go about estimating how much of your sales are gonna be returned?
Will this happen?
That's, yes, that's the first lever we should be reasonable. Oh, what happened last year? Okay, great. If you're if you're Levi's, Levi's and Cisco have been around for almost 100 years, they sell the same pair of jeans for almost 100 years. You have a pretty good history to look back on and can probably tell to the second decimal point what percentage of your inventory is going to be returned. Okay, great. Well, let's start there. Let's use Levi Strauss as our example. They sell jeans to a customer for $130 on account. Those jeans cost $80, and they expect returns to be 3% of sales. So that 3% of sales is based on their own history. They know pretty gosh darn close what those returns are. But I want you all to know with certainty that Levi's are the ones that came up with that number. So if they get to pick the number, that introduce an opportunity for shenanigans. You bet, absolutely. Yeah. Let's walk through this transaction, and then I want you to tell me if you're trying to boost your earnings line, does that number need to be 3.1% or 2.9%? Okay. So here's how it works. We're gonna establish an allowance account for 3% on the one pair of jeans that we sold. Obviously, they're doing this thousands of times every day, but in its simplest form, we're gonna credit allowance for return for sales returns and allowances of $390. And we are going to debit sales returns and allowances for $390. Now we have to make a second entry to adjust for the cost of goods sold. So we just anticipated one pair of jeans being, or 3% of our sale being returned. Well, when 3% of our sale is returned, now we have inventory that we also need to adjust for. But the inventory is only $240 because the jeans only cost $80. So we make a complimentary entry for $240, and we credit the cost of goods sold adjustment, and it flows through to our income statement like this. So we're going to report sales net of this adjustment. So we're going to report $130 worth of sales net of an allowance account that we booked for $390. We have revenues of $126.10 on our income statement. Less cost of goods sold. We sold one pair of jeans for $80, but we had to make an allowance for $2.40 of that coming back into our inventory. It looks like nonsense when you're breaking it down by one pair of jeans. Either one pair of jeans can be returned or it can't, but bear with the example. So $2.40 was returned. So now we have inventory cost of goods sold at 77 with gross profit for 48. So if we wanted our gross profit to be $50, what would we have to do to our estimate? Does our estimate need to be 4% or 2%, higher or lower? Lower? Yes, sir. If we estimate that fewer sales are gonna be returned, then this number's higher. This number's a little bit higher too, but our gross profit is gonna be higher. So we're gonna, again, we're storytelling. At the end of the year, we're conferring with our chief financial officer and the rest of the executive team. And we say, you know what, by golly, these jeans are higher quality and more stylish than any other brand or line of jeans we've ever sold before. I don't think as many of them are gonna be returned. We should adjust our sales returns and allowances. We should make that 2%. I think that's a better reflection of reality. Tell whatever story you need to tell, just make it 2%, it's gonna flow through to the bottom line, and you're gonna get yourself paid. That's the little game of follow the penny.
So you want to
Jessica?
slightly, Janessa,
Janessa,
you want to slightly overdo it, so you're gonna get that.
no. I'm a strange dude. Every time I look at a set of financials, I've trained my brain to think, how would somebody manipulate the accounting? How would somebody manipulate the financials if they weren't that honest? If they wanted to get themselves paid instead of acting like an upright business person and reporting financials that were good and true and a solid economic representation of what was going on in the business, then you do just what you said.
Okay.
Yeah, if you're playing shenanigans with the GAAP accounting and you're trying to get yourself paid, then make that number less than 3. If you're just being honest and you're trying to be a good dude, a good business person and tell everybody what's really going on inside of your company, then make it 3. Look back at your history and make it an honest 3. My point is, the company gets to estimate that number. And anytime you're dealing with an estimation, you should take it with a grain of salt. Okay. Let's dig a little bit deeper. You'll see a table like this in the back of your 10K product. So look at the notes and we're going to break down your sales returns and analysis by the last several years. So you can understand how they're moving over time. That trend analysis will help you identify any outliers. And when you identify an outlier, you can ask the questions about what's driving that and come to a conclusion yourself for whether or not that might be a little gamesmanship on the part of the management company. So in this example, we're still looking at Levi's, I think, and this is a typical disclosure. So we're going to see sales returns in millions going back 2022, 2021, 2020, 57 million. Sales return in 2022, 51, 49 million. Additions charged to net sales. So they sold 327 million in 2022, or this is actually additions charged to net sales. So this would be their sales returns and allowances account. And then they deducted 330 from that. So their estimate is over here, 327. The actual returns falls here under this deduction column of 330. That's pretty close. They estimated 327. They actually had 330 returned. Way to go, Levi's. That's pretty good. In 2021, they estimated 312. They had 306 returned. 2020, 295. They had 291 returned. So Levi's, all in all, is doing a pretty darn good job of estimating how many jeans they're going to have returned. In the second table, we have sales discounts and incentives. So this functions in a similar way. These are just discounts we're dealing with instead of returns. We have to estimate those on an annual basis too. We want to see these numbers come pretty close. Their discounts, they estimated at 436, but actually recorded 461. So they were off by almost 10% with that one. So compare those numbers and see how accurate they've been over time. That gives you some indication of maybe how truthful a company is being. And then we want to look at the additions charged to gross sales as a percentage of gross sales, so I'll just jump straight to the math here. This is another great way to identify any outliers. We'll take the additions charged and we'll just divide that by gross sales. So in 2020, Levi's estimated that 11.9% of gross sales would be returned. Oh, here's the allowance account. Their allowance account divided by gross sales. 3.7%, 3.2%, 2.6%. So that's a big move. We would want to know what's going on. How does your allowance account, which suggests the percentage of jeans that are going to be returned, go from 3.7 to 3.2 to 2.6? And what happens to earnings when your allowance account goes from 3.7 to 3.2 to 2.6? So they're getting, well, we'll just call it more conservative or more aggressive in their reserving. When you reserve 3.7% of sales, that's 3.7% of sales that you don't get to book as revenue. Here they have 3.2, here they have 2.6. This is identical to the example we just looked at a couple slides ago. More earnings are dropping to the bottom line. 2020, 2021, 2022, we can look at that a different way. Adequacy. So this is the estimated returns divided by the actual returns. So their estimate was higher than actual in 2020. Their estimate was higher than actual in 2021. Their estimate was lower than actual in 2022. So more earnings are dropping to the bottom line when your estimate is lower than actual. And this is a good disclosure. This disclosure tells us exactly that. If we start right here, although sales allowance numbers are audited, it is still possible for managers to pad or shave their estimates to help the company meet net sales or earnings targets. So we do have some oversight. Pricewaterhouse or Ernst & Young or somebody's going to come in and look at our accounting and give us an opinion on it. But in this disclosure, we can see these are ultimately estimates. We can use those estimates to pad or shave the accounting and earnings. Okay. Okay, let's assume for a moment that you're looking at whatever company it is that you have to look at this semester, and you're going through this analysis, you get sales returns and investment project, and we look at the ratios of them. And something jumps out. You're like, something's not right. Now, as the financial analyst, it's your job to recast these financials. And you're going to get homework problems that ask you to do that. When I use that word recast, you can tell me what comes to mind. So recast simply means you're going to restate the financials as if. And the as if is whatever you want. In this case, we're going to restate the financials as if Levi's had used a historical addition sum. So what's that mean? Well, that means that the additions charge divided by gross sales calculated to an average of 11.338% over the last 3 years. So we, as financial analysts, can say, well, let's just use that number. If that's the historical average, and I think management's being aggressive with the accounting last year, I'm going to throw that out. I'm gonna use the historical average. I'm gonna recalculate the financial statement. That's gonna give me a better representation of what I think really should be going on, because I'm accusing them of manipulating the numbers at this point. So the gross sales, 5 billion, 6 billion, 6 billion. The average percentage of additions from 2022 to 2020 is 11.338%. So we've thrown out the numbers that Levi was using in 2020, which looked low. And now we're going to use an average in each of those years. And we're going to adjust the additions charged. So in this instance, we're going to charge 572 million, 736, 785 million. And we're going to subtract the reported additions, so 600, 732, 763. And then we have the adjusted less reported. So now we have $27 million worth that we're going to subtract from net earnings in 2020, or this is actually revenues, but same difference. 4.3 million in 2021 and 22.8 million in 2022. And we have successfully recast the financial statement. I don't anticipate you all having to do this on your research projects. I do anticipate you all having to do this on a homework problem or on a test question. And that will be about the extent of how technical it is. Okay, let's move on to deferred, i.e. unearned revenue. So I want to direct your attention to what would be the fourth bullet point on this slide. When the good is provided or the service is rendered, the unearned revenue liability is reduced and revenue is recognized. So think about some of the companies that thought we had some good examples on here. Maybe these are some common examples of when we would recognize unearned revenue. So we receive advanced payments from customers. Give me an industry that receives advanced payments from customers. How about Netflix? First thing you do when you sign up for a Netflix account is pay Netflix. Now they have your money. They haven't done anything for you. They've promised to do something over the course of the next 30 days, but they haven't done it. So that's unearned revenue. How about insurance companies? State Farm, Allstate. What's the first thing you do when you sign up for insurance? You write them a check. Well, they haven't done anything to earn that check yet, so it comes in as unearned revenue or deferred revenue. Gift cards, the same way. Company collects cash without doing anything. Sell memberships or subscriptions. All good examples of companies that have large unearned or deferred revenues on their books. Walmart has sources of unearned revenues. One would be gift cards. We talked about that. Another would be their membership fee program. Anybody sign up for Walmart's membership fee? We're huge fans of Walmart's membership fee at the Cushenberry House. They deliver to our door with for $100 annually. They will deliver as many times a day as we want them to deliver. 3 or 4 times a day. They'll come by, drop their packages on our doorstep. We don't ever have to go to Walmart. It's fantastic. I love it. And Walmart's doing really well on accounting. Okay, let's take the example of Netflix. This is a very common conversation for Netflix. When they report their earnings, they report new subscriptions. And when their new subscriptions are rising, their cash is coming in the door because you have to pay that subscription fee from day one. So they collect the cash and they book that as deferred revenue. So when their subscriptions are rising, their deferred revenues are rising, or unearned revenue is rising. That's the sign of a healthy company, if you're not. When unearned revenue begins to fall, they're no longer booking new subscriptions at a rate that's consistent enough to replace subscriber churn. And that can be a red flag when you see unearned revenues begin to fall. Unearned revenues show up on the balance sheet as a liability, and you can think of it as a liability because it is actually something that we owe. We don't owe cash, but we owe the delivery of a good or service. We've made a promise. Now we have to deliver on that promise at some point in the future. That's why unearned revenues are technically a liability. And you would think to yourself that when a liability declines, we're paying off the debt. That's a good thing. Except if it's an unearned revenue. Because a decline in unearned revenue is actually a failure to onboard new subscribers in the case of Netflix. And that's what these bullet points are telling us here. I just wanted to take a moment and pause and walk through that so everybody had a good understanding of why what seems good can actually be bad. Doing good on time. Let's talk about foreign currency. Okay, you will have this one. Most of the companies that we're all working on are global in nature. So at the end of the year, if I'm looking at Apple or Walmart or Biden, they all have subsidiaries. Europe, Asia, Latin America. And we have to take, if we're in China, we have to take renminbi. If we're in Japan, we have to take yen. If we're in Europe, we have to take euros. If we're in South America, we have to take whichever country's currency that we're working with. We have to translate that back into US dollars. So if the dollar during that period of time has strengthened relative to the foreign currency that we earned, we're going to translate that back into fewer dollars. That can result in a translation loss. If the dollar has depreciated relative to a foreign currency, we're going to translate those foreign earnings back into dollars, and they're going to translate into more dollars. That's going to show up on our income statement as a translation gain. Anybody know what the dollar's done this year? Down. The dollar is down significantly this year. So any company that's based in the United States that has significant operations overseas is in the process of translating all those earnings right now, because your annual reports, if you're on a calendar year, they're due March 31st. You have 90 days to get them in. So right now we're in the thick of it. They're all translating those earnings back, and they're showing up as big translation gains. So if you wanted to think to yourself, okay, I understand this dynamic now because we just talked about it as part of module 5. I wonder what companies are going to benefit from big translation gains in the next 90 days. You would go looking for companies with very large operations overseas. And you look for currencies that have the widest dispersion. So I know the dollar has been down versus our basket of currencies. But I don't know like specifically which currencies have the biggest spread or biggest dispersion, but that's what I would go looking for if I wanted to identify a company that was about to benefit from this in a big way. Okay, here's how it impacted Pfizer. This is a couple of years ago, but Pfizer's disclosure read something like this. Pfizer's MD&A reported revenues increased 23% in 2022, reflecting an operational increase of 30%, as well as an unfavorable impact of foreign exchange of 7%. So in this is exactly what we just talked about. Their operational increase was 30%. So if you just look at their business year over year, they grew by 30%. But when you translate that growth back into dollars, because the dollar would have had to appreciate it over this time. You get fewer dollars and lower growth of only 23%. So that was an unfavorable drag of 7% because the US dollar had strengthened during the year. And that was 2022. So again, on the heels of COVID there. One more point I'll make on this before we move on is that those gains are, where was it? Those gains are foreign currency. Okay, foreign currency effects are largely translation, not transaction effects. What's that mean? Translation, not transaction. Okay, I can translate that for you. These are not real gains. They're just something that we book on the income statement. Those currency translation that I just walked you through, that's not really yen or euros. They come in dollars. All of those euros stay in the bank accounts of the foreign subsidiaries that Pfizer owns in Europe. All that money stays there. All that cash stays in Europe. We just translate it so that we can prepare a balance sheet and an income statement for our investors. At the end of the year, we have to tell them something. We have to denominate this all in dollars to make the financial statements useful. But we're not really moving currency. So it's just kind of makel. It's just something that we write on a piece of paper that represents a translation that we did at one point in time at the end of the year so that we could try to present useful training. But it's not really the way it works. The strength of the dollar or weakness of the dollar, if you turn around this year and that operational loss could be an operational gain just as easy the next year. So it's not real. Okay, accounts receivable and uncollectible accounts. I won't spend much time on this because we already talked about sales, returns, and allowances, and this is the exact same thing. When we book sales, we know that some of those are going to be returned. When we book sales on credit, we end up with something called accounts receivable. And we know that not everybody's going to pay us. When we book a sale on credit, there's going to be some debt. 1%, 2%, 3% of the sales that we book on credit are ultimately going to go back. So just like we have to make a reservation for that when we're booking revenues, we have to make a reservation for that when we book accounts receivable. And there are estimates that are involved in that. I'll show you how it works. On the balance sheet, you have assets, cash, short-term investments, and then trade accounts receivable. So this is accounts receivable less the allowance for doubtful accounts. That's what we're talking about here, the allowance for doubtful accounts. What you're likely to see, it's a little easier with sales returns because we just, it's historically 3% of sales have been returned. We're going to use 3%, just like we did for Levi's and that a minute ago. With accounts receivable, we look at it a little bit differently and we create something called an aging of accounts receivables. So with an aging of accounts receivable schedule, we're going to show that we have a receivables balance of $50,000 that are current. It's probably $1 million. It's 50 million current. 30 million that are 1 to 60 days past due. 15 million that are 61 to 90 days past due. And 5 million that are 90 days past due or more. And this is where history comes in. When we break it down like that, we can get a little bit more accurate in terms of forecasting what's probably going to go bad in the future. So from our own history, we know that 2% of accounts that are current ultimately go bad, 3% of accounts that are past due go bad, 4% that are past due more than 90 days go bad, and 8% of those past due over 90 days eventually go bad. So if we know our current balance and how it breaks out, we can multiply it times these historical numbers to show that of the way that breaks down, we have 1 million of our current accounts probably going to go bad, 900,000 of our past due accounts probably going to go bad, 600, 400, for a total of $2.9 million worth of reserves that we need to book against the accounts receivable balance to report a net number of $97,100,000. That represents our best efforts that what is actually going to be turned into cash at some point in the future. So that's a very common way of coming up with the accounts receivable number. It's not the only way, but it's probably the only way you're going to be tested on in this class. Here's how the basic accounting transaction breaks down. When we know what that number is, after we've prepared our aging of accounts receivable schedule, we're going to book 100,000 in accounts receivable, and then we're immediately going to book an allowance account for the 2,900 that we just calculated, and that's going to be set against a bad debts expense of 2.9 million, and it's going to show up on the balance sheet as accounts receivable less allowance net accounts receivable. So it's the estimate part is a little different than sales return and allowances, but the process we go through to get there is identical. We looked at these two ratios when we were looking at the cash conversion cycle in Module 3. They're both very helpful for identifying if our accounts receivable is getting healthier or less well off. Accounts receivable turnover is the top one. We take sales and we divide it by average accounts receivable. We like to see that number probably going up. Days sales outstanding, we take 365 days divided by accounts receivable turnover. Both of those ratios, when laid out in the spreadsheet over time, can help us analyze any trends and identify any outliers. We also want to look at those ratios relative to our peer group as we grow. Okay, now let's get into the potpourri. That's all I wanted to say about accounts receivable. Let me go down here to learning objective 5.6, analyze operating expenses and discontinued operations. Once we have revenues on our income statement, now we're going to go down the income statement and look at this is our authors are walking us through the most common roll-ups that you're going to see on an income statement. So the next one is cost of sales. Traditional manufacturing industry, you're going to see cost of sales, and then you're going to have selling, information, and administrative expense, followed by research and development, amortization of intangible assets. We'll talk a lot more about these in the weeks to come, but our authors give us a nice preview of the most common items that you see on an income statement. Restructuring charges, we'll talk a little bit about that in modules to come. Provision for taxes, we have a whole module on that. Discontinued operations, income attributable to non-controlling interest, which we covered a few weeks ago. R&D costs, these are expensed on the income statement. This is a good one for analyzing companies. Well, companies like Pfizer, that's an example that our authors are given on the five. So see Pfizer, what you want to do is look at their research and development expense as a percentage of sales going back over the history of the company. When you see research and development expense start to decline a little bit, and this isn't a gap. This is just a lever that any management can pull if they want to increase their earnings. Just pull the reins back on research and development expense. That's a red flag, but it always shows up as a green flag for them. Because the first thing that you're doing is saving money. And when you save money, you increase your bottom line. So you're going to sacrifice the future because you're not spending as aggressively on research and development. When you don't fund research and development, you don't fund future products, you don't fund future revenues. So you're sacrificing the future for the now, but it always looks good in the now. So just know that that's a little bit of a red flag. So analyze research and development costs closely and through that lens. Nice chart our authors give us on kind of the median expense, and I don't expect there's anything on that chart that would surprise you. Semiconductors and equipment are the highest on that chart in terms of R&D spend over time. And this is a good example of what I want you all to do for the companies that you're analyzing this semester. There's Pfizer again. Over the period of 18 to 22, you can see their R&D expense went from 19% of revenues, 19 to 20 to 20, and then 12 and 11. So something happened in 2021 and 2022 that caused them to cut their research and development expenditures almost in half. Why? Why? I don't know the answer to that question, but that's the first question that you need to ask yourselves and the management team that you're working on. You know, why was it cut in half? And maybe they have a good reason for that. I don't recall what Pfizer was going through during that period of time, other than COVID, which might have been the reason enough. But a lot of times you'll see companies cut their research and development spending when they go through a merger or an acquisition. Like say, usually it's R&D expense that brings future innovation to the market and allows you to grow your revenues in the future. But sometimes management teams come to the conclusion that it's not working. Their R&D department is just not as competitive as some of the other players in the marketplace. In which case, they'll take all those R&D dollars and they'll just go put them to work in M&A. You don't have to internally develop your own pipeline, your own innovation pipeline. You can just go buy it. So that's another way to grow your revenues over time. Is just go buy your competition. That happens all the time in pharmaceuticals and other industries too. Okay, so that's R&D. I'm not going to talk about taxes tonight because module 10 is 100% taxes. So our authors are just kind of giving us a preview of what we'll talk more about later in the semester. Discontinued operations. Wait a minute. EBITDA. When you hear the term EBITDA, I want you to translate that as nonsense. So EBITDA is it stands for earnings before interest, taxes, and amortization, depreciation and amortization. What you need to recognize is that's a non-GAAP number, so there are no rules whatsoever that govern that. Management can publish any EBITDA number that they want, and then they'll typically disclose how they came to that transaction. What it is a headline revenue or headline earnings number with all the junk that they don't think is real or relevant or germane thrown out. And then you think to yourself, well, that junk was real, it was relevant, it was germane, it really did cost you money, it really did represent bad decisions that you made. I understand that you don't want to be accountable for those bad decisions anymore, but the money's gone. So I think you should probably be included in your EBITDA transaction, but that's not the way EBITDA works. Nonsense. So just know that when you see EBITDA, that can be a very suspect thing. Now, management will tell you how they got there, and they'll give you a good story about why it's more relevant. So pay attention to what they're telling you and decide for yourself if they're shooting you straight. But EBITDA can be a very dangerous number. Discontinued operations. What you need to know about discontinued operations when you see this on the income statement is that it's always reported net of tax. And that it's below income from continuing operations. This is another trick of EBITDA. EBITDA never includes discontinued operations. So it's very common for management to say, well, I don't like this little area of our, we're going to take that, we're going to call it discontinued operations. This includes it in our money. And then we're not going to have to be held accountable for running that division anymore. And we're going to scuttle it over the period of the next 36 months. And for the next 36 months, we're going to publish it as discontinued operations on our income statement. But we're not going to pay attention to it because it's income from continuing operations that means more to our shareholders. That's what we're going to focus on. Common story. When you see it, just know that it can be a place for management teams to hide bad decisions. Go do a little digging, understand what these losses are, why they're there, and if they're actually an indication that there may be a deeper problem for you down the road. And okay, I think this is last section, pro forma and non-GAAP disclosures. Okay, you're gonna see companies issue pro forma numbers all the time. And there are a lot of genuine reasons for a company to issue pro forma, the most common of which is they've gone through a merger or acquisition. So I forget the example I often give, it's like mine and Gillette and Procter and Gamble. So Procter and Gamble buys Gillette. And that was a pretty good sized purchase, $50 billion. And when a purchase is that big, it can distort your finances. If all of a sudden you merge two companies that are in excess of $50 billion, then in 2026, when you report those financials, they're not comparable with anything you've ever published. So companies will republish past financials as if those companies had been merged the whole time. Those are called pro forma numbers. And they're about that is an excellent exercise for them to offer and to go through. Just know that for any of those items that are non-GAAP in nature, you'll be able to find a schedule that reconciles the numbers back to GAAP in the notes or the fine print of the annual report. Okay, that's it, gang. That went a little quicker than I thought. I hope I didn't shortchange you on any of those slides, but the ones I skipped were the simplest and most self-explanatory. So that's module 5. We still got the test open for another week, so make sure you get out there, take that. I would like it went okay for at least one of us. Otherwise, we don't have class next week on ground, so we will have a virtual. So another reminder for that, and I'll see you in person in 2 weeks. Thanks, guys. Have a good night. Oh, happy Fat Tuesday, by the way. So go celebrate. It's also, I don't know, I can't imagine this happens very often, but you might also know that today is the Chinese New Year's Day. So we're celebrating Fat Tuesday and Chinese New Year. Happy Year of the Horse.
My dad's a horse.
Your dad's a horse? Well, tell him Happy Year of the Horse.